All right, welcome back. Today, we're going to peel back the layers of the stock market. We're going to explore a method that really helps you see past all the daily noise to get to what a company is truly worth. And that method? It's called fundamental analysis.
You know the feeling, right? Every single day, we're just bombarded with financial noise. Stock prices are jumping up, they're crashing down. You've got experts on TV shouting predictions. I mean, how in the world do you cut through all that chaos to find the real underlying value of a business? That is the core question we're tackling today.
Okay, so to answer that question, we first need to understand the world we're trying to see through, you know? And that means looking way beyond just the constant stream of market data flashing on your screen.
And what's really wild is just how easily we can get distracted. I mean, the stock market can feel like it's driven entirely by emotion, right? Fear, greed, excitement, people making these super quick trades. But here's the thing. All that stuff, it often has very little to do with the actual health or the long-term prospects of the company itself.
So if the market is all about emotion, how do we find a more rational way to figure out what a company's worth? The answer, my friends, lies in finding its genuine or what we call its intrinsic value.
And this is where fundamental analysis comes in. Honestly, the best way to think about it is like a home inspection, but for a business, right? Before you buy a house, you check the foundation, you look at the plumbing, the roof. It's the exact same idea here. Before you invest, you've got to check the company's financial health, its strategy, and crucially, how it stacks up against the competition.
And this slide really highlights a massive difference in mindset. You see, the market is almost always focused on the short-term question, right? Where is the stock price going next week? A fundamental analyst, though, they're asking something much, much deeper. They're asking, what is this entire business worth, right now, today?
Oh, I absolutely love this quote because it just gets right to the heart of the philosophy. It forces you to stop thinking about wiggly lines on a chart and start thinking about customers, products, and long-term strategy. You're not just renting the stock for a few days, you are mentally owning a piece of the actual enterprise.
And that's the end game. That's the whole point of all this work. It's to arrive at a single number, an estimate of the company's intrinsic value. Think of it like your anchor, your North Star. It's the figure that you can then compare to the current market price to see if there's a good deal to be had.
Okay, so how do we actually do this? Well, it's not magic, it's not some secret art, it's a structured process. So let's take a look at the blueprint.
The whole thing can really be broken down into 4 key steps. First up, you've got to understand the business and its moat. We'll get to that in a sec, but it's basically its competitive advantage. Step 2, you scrutinize the financials. You're digging into revenue, profit, debt, all the good stuff. Then, step 3, you use all that info to forecast the company's future cash flows. And finally, you pull it all together in a valuation model to calculate that intrinsic value.
And let's be clear, that first step is absolutely critical. A moat, you'll hear that term a lot, it's just a fancy word for a company's durable competitive advantage. You gotta ask yourself, what makes it hard for a rival to come in and steal their customers? Is it a super powerful brand like a Coca-Cola? Is it unique technology and intellectual property? Or is it just a massive pain for customers to switch away? A strong moat is what protects the company's future profits.
All right, theory is great, but let's make this real. Enough talk, right? Let's walk through a quick valuation of a fictional company we'll call Acme Clean Energy.
So here's a quick snapshot of Acme Clean Energy. Let's see, they're in the solar industry, making inverters and software. Last year, they pulled in $1 billion in revenue, which is pretty solid. Their adjusted EBIT, that's basically a measure of their operating profit, was $118 million. We also see they have some debt and 120 million shares out there. These are the key numbers we're going to start with.
Now, before we start forecasting anything, we need to focus on what is arguably the single most important metric in all of this, free cash flow. And look, this isn't just some accounting profit number. This is the actual, cold, hard cash the business generates that could be handed back to its owners. This, right here, is what truly determines a company's value. It's the lifeblood.
Okay, so now we take our understanding of the business and we use it to project its free cash flow out over the next 5 years. Based on our assumptions about their growth and how profitable they'll be, we can see their cash flow is expected to grow from about $96 million all the way up to over $200 million. This is our best guess, our most educated estimate of the cash the company is going to generate. The next step is a little bit of financial magic. We take all those future cash flows and we discount them back to what they're worth today. It's that old idea, right? $1 today is worth more than $1 in the future. So after running the numbers, after doing all the math, we arrive at an estimated intrinsic value of $22.68 per share for Acme Clean Energy.
And this is so important, is that number 2268. Is it perfect? No way, absolutely not. The real value here isn't in the decimal points. The value is in the process. It's a logical, transparent, repeatable framework that turns a business story into a number. And the best part is anyone can look at your assumptions and say, hey, I think you're wrong about this, and you can have a real debate.
Okay, so let's zoom back out for a second. This whole exercise from start to finish is really about one thing: shifting your perspective.
And this slide provides a fantastic summary of where this all fits in. Think of it this way. Fundamental analysis is all about the what. What is a high-quality business to own? Technical analysis, which you've probably heard of, is more about the when. When is the right time to buy or sell based on charts and market behavior? See? They're two totally different tools for two totally different jobs.
And that really is the ultimate takeaway here. Fundamental analysis isn't a crystal ball. It's not about predicting the future with perfect accuracy. It's a structured way of thinking about a business, of understanding what makes it tick, and of putting a reasonable price on a very uncertain future. At the end of the day, it's about replacing pure guesswork with a solid framework for good judgment.